All right, we're going to switch topics. We're going to go to the government and the economy. Dan, this question's for you. The recently enacted federal stimulus package and others by the Federal Reserve are significant. How do we compare the government's response to the 2008-2009 crisis to this, and do you think that they will be effective?
Okay. So the fiscal stimulus and monetary responses are both massive. I don't think you could describe them in any other term. You know, this is the biggest fiscal stimulus package in our nation's history at roughly, $2.3 trillion. That equates to more than 10% of annual U.S. GDP, and it really, dwarfs the amount of fiscal stimulus that we saw back in 2008 and 2009, which I believe came in at around 800 billion. And if we take a look at what the Federal Reserve has done in pretty short order, they've cut interest rates to zero. They've announced an unlimited quantitative easing program, and they've reopened these emergency programs that were created back in the financial crisis, really with the goal of boosting liquidity and supporting financial markets. So if we look at the combination of fiscal and monetary response, that equates to something close to 30% of U.S. GDP, and as we've all heard, there's more coming. So it's not just the U.S. It's every other major economy is really following suit with similar programs and similar goals. And we've already seen some of the Fed's actions, relieve some of the significant stresses in financial markets, in the fixed income markets. And we know, another one of their goals for quantitative easing is to support prices in equity markets as well. So I think another important point is that we're not being naive. We don't anticipate, these stimulus efforts to necessarily, spur demand, but the goal is really to bridge the gap until, the economy reopens and to help us with the recovery on the other side.
Great. Charlie, I'm going to go over to you with this next question. There's great debate, this stimulus cure potentially being worse than the market decline disease. So can you talk about what the long-term impact will be from the magnitude of the stimulus package, and how long do you think it's going to take us to climb out of that hole?
Well, that's another good question, because if the efforts in terms of particularly in terms of what the Fed is doing with regard to new money creation and bond buying, if that gets overdone, there's a potential for inflation on the other side. And I think that's probably the biggest potential risk coming from all these stimulus cures that we're seeing. But certainly the rapidity and the size of the Fed's response got the market's attention. Just over 2 weeks ago, Fed Governor Neil Kashkari appeared on 60 Minutes, the evening of March 22nd it was. And he said the Fed basically would do whatever it takes to stabilize the markets and the economy. And he put a floor under the entire financial system. And the S&P has rallied over 19% since that day. So we don't know if the fallout from the unlimited money creation, at least for the short term, will result in much higher inflation, or perhaps a weak growth and grinding deflation like we saw after the last crisis. So we're not really certain whether we're going to see an inflationary wave or the recovery will look more like the one we saw coming out of the last crisis, or some combination of the two. But the risks, certainly given as the size of the stimulus that Dan mentioned, are comprehended. The risks are that we could see some significant inflation, and we'll be on the lookout for that.
Right. Charlie, do you have a projection for when you think the economy, GDP, and employment, et cetera, might return to normal?
Well, timing is always the most difficult aspect of this. If we had to guess, because of the nature of the decline, that is, it was not a classic recession. It was more of a purposeful cessation of economic activity. We think we could see just as rapid a recovery once we've got the economy open again. Obviously, we're not going to open the economy all at once, as I talked a few minutes ago. It's going to be a staged reopening. But there's no reason for me to believe that once we take ourselves out of this sort of medically induced economic coma, that we aren't able to recover fairly quickly. Once businesses everywhere begin to comprehend and implement new ways of doing business that are necessary in the post-COVID-19 world, the recovery could become surprisingly robust. And particularly the prospect of a protective vaccine arriving later this year or early next would also sort of provide an additional boost to confidence in the economy at that time as well.
Yeah, I like that metaphor a lot, the medically induced coma. It's an interesting way to put it, Charlie. So Dan, let's go to you with this one. Will this change the economy and market models? Or excuse me, the economic and market models. My apologies.
Yeah, great question. And Charlie and I, as well as the rest of the investment team, have had a lot of good dialogue and discussions about how the environment will change, both economically and in terms of financial markets. And most of our discussions, at least so far, have centered around topics like supply chains. Or are we going to see a push to relocate supply chains back to the U.S.? Is globalization coming more and more into question? Back to some of Charlie's points, how do these massive budget deficits and the prospects of helicopter money impact the interest rate environment and our prospects for growth going forward? And I think maybe more specifically, topics like what does the workplace look like after we've all spent weeks and months working remotely, and how does that impact the real estate market, real estate values, et cetera? And then there are a number of second order effects of the pandemic and the changes it's really forced on our collective behavior, which changes are permanent, which are not. So I'd say there's a lot to think about, but in areas where we believe the changes are indeed long term and will have long lasting impacts, whether those are positive or negative, those are the situations where we anticipate making the necessary adjustments in client portfolios.